The treatment plan came to $14,000. A cracked molar, a failed crown, a bridge, and the root canal underneath it. You have dental insurance. You have had it for years. You hand the front desk your card and wait for the good news. The good news is small. Your plan will pay $1,000, not toward this visit, $1,000 for the entire calendar year. The rest is yours. You ask if that is a mistake. The receptionist does not even look up. That number has a name. The annual maximum. The most your dental plan will pay toward your care in a single year, no matter how much work you need. For most plans today, it sits between $1,000 and $1,500. It is printed on page 1 of your benefits summary, in plain type, without comment. It looks reasonable. It is not. It is a relic, and the year it was set tells you almost everything. Employer dental coverage took its modern shape in the early 1970s. When those first plans were written, a typical annual maximum was around $1,000. In 1970, that covered a great deal of dentistry. A crown cost a fraction of what it costs now. A $1,000 cap could carry a patient through nearly any single year of routine and major work. The number was generous. It made the coverage feel like coverage. Then, it stopped moving. Run the inflation forward. $1,000 in 1970, adjusted for inflation, is worth roughly $8,000 today. If the annual maximum had tracked the cost of living, it would sit near $8,000 now. Track it against dental care specifically, which has outpaced inflation, and the gap is wider still. Instead, the cap stayed near $1,000. The coverage did not shrink on paper. It shrank in purchasing power, one quiet year at a time, until it covered a cleaning and almost nothing else. Here is why the number never moved. Dental insurance, unlike major medical, was never designed to absorb catastrophic cost. It was designed as a budgeting tool for routine maintenance, built around the cleaning, the checkup, the occasional filling. Carriers price the premium to cover those, take a margin, and cap their exposure with the annual maximum. Raising the cap would mean raising the premium, so the cap froze. The premium did not. Over decades, people paid steadily more for a benefit whose ceiling stood still. Now layer in how the benefit is structured underneath the cap. Most plans pay 100% for preventive care, the cleanings and exams. They pay around 80% for basic work, like fillings. They pay only 50% for major work, the crowns, bridges, and dentures. The procedures you actually buy insurance to protect against are reimbursed at the lowest rate, and every dollar paid counts against that $1,000 ceiling. By your second crown of the year, the plan is finished paying. There is one more layer patients miss: the waiting period. Many plans will not pay for major work until you have held the policy 6 or 12 months. So a person who buys dental insurance precisely because they need a crown discovers the crown is excluded for the first year. They pay premiums through the waiting period, then often switch plans before the major coverage activates. The structure quietly favors the carrier at every turn the patient is least likely to notice. The consequence shows up in how people avoid dental care. According to the American Dental Association's Health Policy Institute, cost is the single most common reason adults give for not getting treatment they know they need. A cracked tooth becomes an abscess becomes an extraction becomes an implant the plan will barely touch. The $1,000 cap does not just fail to cover the big bills. It nudges people to delay the small ones until they become big ones. For older adults, the gap turns severe. Traditional Medicare does not cover most routine dental care at all. Retirees who kept employer coverage for decades often lose it the day they stop working, exactly when their teeth need the most attention. They buy a standalone plan and meet the same $1,000 cap, the same 50% on major work, the same waiting periods. A full set of dentures can run several $1,000s. The plan pays its cap share and stops. The rest comes out of a fixed income. So why has no regulator forced the cap upward? Because dental insurance largely escaped the reforms that reshaped medical coverage. The Affordable Care Act banned annual dollar caps for essential health benefits. Adult dental was not classified as one. The annual maximum outlawed in major medical remains perfectly legal in dental. The protection on the medical side does not extend to the dental one. The cap survives because the law that would have killed it was written to walk around it. Knowing this changes how you should shop. First, do not buy on premium alone. A plan that costs $10 a month less, but caps at $1,000 instead of $2,000, can cost you far more the year you need a crown. Compare the annual maximum directly. Second, read the major services percentage and the waiting period together. A 50% benefit you cannot use for 12 months is not the benefit it appears to be. Third, run the arithmetic before you buy it all. Add the annual premium to your expected out-of-pocket share, then compare it to paying cash. For a healthy adult who needs only 2 cleanings a year, the premiums can exceed what the cleanings would cost out of pocket. Dental insurance can be a losing bet for the person who needs little and an inadequate one for the person who needs a lot. The band where it pays off is smaller than the marketing suggests. Fourth, ask the dental office about its own options. Many practices run in-house membership plans, a flat annual fee that bundles cleanings and a discount on major work, with no annual maximum and no waiting period. For people without employer coverage, these can outperform a capped policy outright. The dentist would often rather collect a predictable fee than fight a carrier over a $1,000 ceiling. Ask. The answer is frequently better than the card in your wallet. The deeper point is what the word insurance is doing here. Real insurance protects you against the rare, ruinous event. The $1,000 dental cap inverts that. It covers the small and predictable, the cleaning you could have budgeted for, and abandons you with the catastrophic bill insurance is supposed to exist for. It is, structurally, the opposite of what it claims to be. A maintenance plan wearing the costume of protection. Once you see the cap for what it is, the brochure stops reading like a promise. The number was set in 1970, and it never grew up. Everything around it grew. The cost of a crown, the price of an implant, the premium on your paycheck. The cap stayed a child. So the coverage you think you have is a photograph of a benefit that stopped existing decades ago, framed and sold to you as current. You will not change that by complaining at the front desk. But you can stop paying for a promise that expired before you were born. Read the cap first. It tells you everything the brochure will not. If this one stayed with you, episode 7, the middleman charging you $80 for a $10 drug, goes further down the same road. It pulls apart the pharmacy benefit managers who sit between you and your prescription. It is on this channel.